Hey guys, Josh here back for another video. In today's video, we're going to be discussing major issues that real estate investors are facing in Canada in 2023. Now, as many of you know, we've seen unprecedented rate increases, and that has caused some undue hardship for the majority of investors who are on variable debt. In turn, that has caused some challenges in the market and some shifts to where assets are being purchased and how business is being done. So in today's video, we wanted to discuss what these challenges are and how people are going about dealing with these challenges and finding solutions in today's market. Obviously, one of the most glaring and specific challenges that come to mind is rise in interest rates. For most people over the last 2 years, most people, or investors specifically, chose to take on variable debt, specifically because it was very cheap and it gave you the ability to be able to restructure your debt without a whole lot of penalty. Now, hindsight is always 20/20. Nobody thought that interest rates were going to do what they did. So the majority of people who were purchasing a few years ago, they were buying these properties and they were restructuring when debt was cheap into variable debt, not assuming that rates were going to increase. Obviously, if you have a portfolio of assets and the entire portfolio is on variable debt, your monthly payment then increases. And unfortunately in Ontario, the rent can't increase at the same pace as what your mortgage is, which is causing a lot of pain in the market for retail investors who have entire portfolios on variable debt. Now, we get questions all the time: is should I lock in? Should I, move my portfolio into fixed debt at this point within the rate hike cycle? Now, I guess it's up to interpretation, and specifically, it's up to your specific situation. If you don't have the ability to be able to cover the cost, or another increase in your overall variable rate is going to put you in undue hardship, I'd say probably lock in some of your debt. If it's going to put you in a really tough spot. But what's important to take a look at is where are we at in the cycle? Where are economists projecting, and what are we looking at in the market, and what's going to happen over the next 12 to 18 to 24 months?
Yeah, I mean, when we're taking a look at where the cycle is going, as of today, we're in basically the end of July. There is still a prediction for another 25 basis points by the end of the year through Bank of Canada. So, keep that in mind when you're starting to take a look at your finances and put together some thoughts and goals as to, where you're going to be at the end of the year and what does that look like for your entire portfolio. But, also your credit cards and your lines of credits as well, too, right? You got to take a look at all of your debt. If you're trying to think ahead and figure out when are some rate cuts going to be coming, we're not really anticipating any sort of rate cuts till at least probably 2025 to be safe at this point. Could they come sooner? Maybe. Inflation's down, but we've heard the talks before of, okay, inflation's under control, and we're not going to have any Bank of Canada increases. So, I would say if you're looking ahead, keep it on the safe side. Plan for things to stay the same until 2025. And if you overplan and you give yourself that little bit of a margin, those rate cuts do come early, then then you're in the green and you're in the bonus. But if you start planning for rate cuts to come early and you're making decisions based on rates coming down, that rate change game, it's a dangerous game, because if you get caught, it really does put a big hamper on everything. So I would at least say, expect these rates to stay the same until 2025 and make your decisions based off of that.
Yeah, I think that's a fair projection. Most economists are projecting out, that obviously we are going to see some sort of rate decrease. And when that is, again, we don't know. Unfortunately, the people higher up have been wrong consistently throughout this entire process. So, we rather be safe than sorry. Now, when it comes to managing cash flow, and that's kind of the most important part with, people who have variable debt on their portfolios, is a cash flow management. And I've seen people who are, losing $1,000 a month and people losing $6,000 to $7,000 a month. And there's a wide variety of solutions that you can, execute here to be able to fix that situation. Now, unfortunately, sometimes the answer is sell. Obviously, we're not in the best market to be able to sell an asset, and it's not as liquid as it once was. But some investors are looking to sell if you are hemorrhaging massive amounts of cash. And then on the other side, if you are losing $1,000, $2,000, there are some ways to be able to cash or manage your cash flow situation. If you break it down by total cost of actual carrying debt, if you build your entire portfolio off of leverage, then you have to understand that if you have tools in your tool belt to be able to manage cash flow, you might be in a situation to be able to weather out the storm. Some of our clients have utilize tools such as home equity lines of credit to be able to take on whatever deficit they're carrying each month. And if you take a look at, let's say you're less than $1,000 a month in your cash flow, and over 12 to 24 months you're taking on $12,000 to $24,000. Well, the carrying cost actually on that debt is decently low. So there are ways to be able to manage your situation. Just really understand what kind of tools you have in your tool belt to be able to combat the situation that you're in. And if you aren't aware of different strategies or ways to do this, there are professionals in the market that can help you navigate this. Each situation is unique, and I would recommend speaking to a professional to be able to manage your current situation.
Yeah, the name of the game right now is preservation, and that could be wealth preservation, but it could also be just your ability to buy a property and invest and preserving that moving forward. So obviously using tools like a HELOC, a cheaper form of interest-only debt to help manage some of this deficit, can be a good idea if you have it, you have the capacity, you have the income to help cover that, but you also don't want to put yourself in a situation where you're racking up your revolving debt, your credit cards, your lines of credits, and you're in a position where you can't refinance your home right now to clear that debt off. Obviously, when these types of debt portfolios start moving towards bankruptcy or consumer proposals, stuff like that, that's the kind of situation where now you're going to start putting yourself in like a classification of the bank where you may not be able to invest moving forwards. Any sort of bankruptcies involving properties obviously are going to be a no-no for the banks and future purchases, or you're going to put yourself into expensive debt moving forward and stuck with private or B-type debt. So again, if it looks like you can't manage that payment on your line of credits or your HELOCs more so specifically, and a sale of property might be in a deficit or a loss, but taking that sale might clear up your monthly deficit. Getting rid of that property, taking a step backwards, but preserving yourself and being able to maintain and buy when the market shifts again is better than just putting yourself under a huge amount of debt and really kind of put yourself in a tight situation moving forwards.
Completely agree. There's a handful of effects that happen when you start taking on more debt. Utilization, affects your credit. If we don't have the rate decreases that we are normally or that we are expecting, that could overall affect your ability to be able to restructure into lower debt. Anticipating lower debt and knowing it's coming versus projecting when that's going to happen are two very different things. We obviously know it's coming. When that happens and how long that's going to take is a whole nother story. So, obviously, this is just a strategy that you can implement by talking to your financial advisor, by talking to your mortgage agent, by discussing your overall risk tolerances. This is just something that we've seen some investors do who are under leveraged at the moment, but who are, losing money in a deficit situation. Something to keep in mind when you are looking to, assess whether to sell or to, hold on and restructure your debt. It's very interesting to see how people utilize, leverage on, let's say, a home equity line of credit to purchase in an up market. That tool is still available for you in a down market, just it's used in a different way. So just understanding how it works and the power of having those tools available to you is really important in a market like this.
Yeah, and people are selling. Like don't feel bad if you're one of those individuals where you realize you kind of overbought and you didn't really correctly read the market over the last couple of years, because very few individuals can say they did predict this. So it's not just you that's considering selling. There are people that are selling. Some people are taking losses, but again, it's putting yourself in a situation to be able to recoup, say, okay, I went a little crazy, the market was great and I thought it was going to be okay, but learn from it, sell, put yourself in a situation to be able to continue to buy when the market corrects, because it moves in cycles, and we're moving towards a correction eventually.
Another challenge in the market that you may not know but is actually happening to you is legislation changing. OSFI has come out and outlined a handful of changes to lending that may allow you or not allow you to be able to qualify for as much debt as you normally used to be able to. We made a video previous to it. If you want to watch it, please do. It goes into greater detail about this, but essentially what's happening is, the banks are taking a look at their books and understanding that there was mass amounts of exceptions made on people in regards to multiples of what they were making and how much debt they could take on. Realistically, back in let's say 20, 30 years ago, you were probably able to take on about 4 times your income as debt. And right now, if you go and take a look at what a home in Toronto costs, you're about 10 times your income to be able to purchase a home. And that obviously caused some people to take on more debt than they normally were able to, and caused OSFI to be able to reach out to the banks and to change or try to change how lending is actually done.
Yeah, a lot of these banks, especially the big banks, they're using some sort of internal credit approval, TDSR type system. So they have, they still have their standard OSFI guidelines that they follow, or they're supposed to be following, but like the obvious one here is Scotiabank, that allows you to go up to a 50% TDSR when industry standards around that 44% TDS. A lot of the big banks are under heat. Scotia's under heat, CIBC's under heat. I think BMO is under heat as well too, and there's been such a large time period of free money and very cheap money that they got away with it. But as the market is starting to correct, we're seeing a lot of these locked in variable rates, guys that are having 75 to 90 year amortizations, or on renewal they're getting hit with this gigantic buy down or this gigantic rate increase to be able to bring that amortization back in line. One of the changes I think that's coming actually is they're going to get rid of these locked in or like non-interest adjusting variable rate type mortgages, which may seem like a bad thing, but as we all just saw, you're really just hiding almost the inevitable. And for the average consumer who doesn't really understand how things work, they just kind of feel like they're in the safe because their rates aren't changing. But if that change or those rate changes keep on increasing and increasing, like we just saw, all of a sudden they're hit out of the blue with like I just said, giant amortizations, giant pay downs, huge interest increases because they just can't keep up with the amortization. So these changes are going to be for the better. I think just in terms of safety for consumers, obviously there's going to be individuals out there that have a higher literacy when it comes to this stuff that may not like it, but overall banks aren't really doing this for the favor of investors. They're doing this for the general good of the population.
I completely agree. I think that the renewal issue or challenge that's about to come up is about to be an extremely difficult time for a large amount of the population. So the majority of banks had that type of very debt. I believe Scotiabank was the only one that had an actual variable option that changed as the overnight lending rate increased and prime rate increased. If you've heard, probably most investors who use Scotia to be able to acquire their assets, they're grumbling and groaning, and they get that letter in the mail every month saying your mortgage payment's gone up, and it hasn't been comfortable, but for most, but the majority of Canadians actually haven't felt that increase yet, and a lot of those renewals are coming up next year and the year after. So it is a massive challenge that our country is going to be facing at renewal. OSFI has specifically come out and guided the banks that they are looking to not allow for massive extended amortizations anymore. Essentially meaning, at the end of your renewal, 30-year amortizations is probably the maximum you're going to get. So if you need to take a look at your current mortgage payment and what does your payment look like at roughly, let's say today's rate at a 30-year am, how does that affect your overall monthly payment? Does it double? It most likely will double your overall cost, which is going to put some stress on the market when those renewals do happen. Again, we can't cross our fingers and hope that interest rates are lower at that point, but the federal government does see this as a major issue that is going to be coming up over the next few years. And as an investor, if you are on a static variable option, you should be running your numbers to understand what your cash flow situation looks like at renewal, because that is going to be hitting quite a few people at the same time, and that may cause some more inventory to hit the market because people can't make their payments.
Another challenge that investors and homeowners frankly are facing is housing prices really aren't moving. I think there was an expectation that as rates increased, it was going to slow down the market and it was going to help cool some of the prices. But I think simply put, like, the supply and demand factor is just, it's overpowering. We had at least 1 million immigrants come into the country last year, and I think we built 200,000 new homes last year. So, we're nowhere near being on track with what the federal government came on their Build the Homes Faster Act that they were talking about, and just in general, taking a look at the economic factors that go into construction. Interest rates are high right now, so the big developers that are your Activas, your Fusions, your Madamies, these guys have a name, and they built their wealth through development, and they're not about to go take on small margin, high cost products just for the sake of building more homes. They're there for a business, and unfortunately I don't think that's part of their business strategy. So unless there's some incentives and some stuff being given by the government to help incentivize them, I just don't see them chomping at the bit to start construction. Cost of materials, still up. I think the other issue too is also just the amount of borrowers and pre-sales that didn't go through. They weren't able to close. We see a lot of developers offering, hey, take here's a $90,000 incentive, and we'll cover your rent for 2 years, or whatever it is. But that's just a sign of how desperate some of these developers are to offload these inventory products just to be able to recoup and maybe break even, maybe hit a small amount of margin. So I think we're going to see, and we already have seen, a shift from new construction for sale to new development for build to rent. So if you're looking to buy, just kind of keep in mind that some of the new inventory that's coming is geared towards build to rent and not build to sell. So that's also going to keep housing prices high if the inventory that's coming to the market isn't even there to be purchased. It's there to just be rented out. Overall, I think regardless of what happens interest rate wise, if immigration stays high and staying near these 500,000 to 1 million, and our homes are keeping around 200 to 250,000 new builds for sale for every year, I can't see housing prices really coming down at all, kind of regardless of what industry professionals say.
Yeah, I completely agree. Obviously, rates have a significant factor in how much inventory moves, but when it comes to value and price, we did see obviously a drop from COVID peak highs, which obviously if you go vertical you have to come back down, but stabilizing out market right now, again, there is massive demand and very little supply. And we take a look internally from the financing side as to how much development is actually happening, and the people who are coming to us, or the clients who are coming to us, as Ehren said, the purpose-built multifamily rentals. It makes sense from an investment perspective, it makes sense from a business perspective. In interest rate environments like this, where developers are incentivized to be able to actually sell homes, we're going to start seeing an emergence of purpose-built multifamily rentals being the go-to. And we already obviously have, and as you've noticed, all of our content has been pushed towards CMHC, MLI standard, and development, because that is where we see the trend going. So if you are looking to buy, if you are looking to invest, we do foresee, kind of values staying consistent with where they're at right now, if not increasing slowly over time.
One last challenge that we just want to touch on too, and I think we touched on this in a bit more depth on a different video, but again, just overall portfolio size is being limited for your residential retail type investor. So OSFI did come out, the change now is 10 properties in a portfolio. So that includes anything in your personal name and anything in your holding company on an application. So if you're going to go buy a rental property in your holding company, and you got, let's say, 3 properties in your personal name, and you already have 7 properties in your holding company, well, that next purchase is going to be your 11th property, and you're not going to be able to move forward on that with a residential type lender. So these changes have come out as well too. So they're trying to just limit, again, the overall amount of debt and risk that these that you guys as investors are able to take on. It is going to push the retail res guys into the multifamily type of space. There is a lot more leniency on portfolio size on the multifamily side. Now, multifamily lenders, they are starting to take a look at overall portfolio debt servicing, just to ensure that you're not just taking on underwater assets, that they are debt servicing, they are performing, they're bringing in income. But again, if you're running into issues with overall portfolio size, that multifamily, small commercial is going to be your next step.
Yeah, that transition from the retail investor, the sirens ring loud and clear. Like, obviously there is a push to stop the retail investor from owning multiple properties. It's becoming more evident as new legislation comes out with OSFI and with the lenders. And in an environment like this, obviously it's challenging to be able to make numbers work. So, that transition or that push into that multifamily space is 100% where we see the majority of investment moving going forward. Guys, we really appreciate you taking the time to watch this video today. We understand that things are tough. Things are hard. Mortgages are hard. Financing is hard. It's all hard. But if you're working with a team who specializes in helping with hard and difficult situations, you're going to be able to get through this. Whether it's us, whether it's another professional, feel free to reach out, guys. We want to be the light at the end of the tunnel. We see the light. It is coming. When that happens, we don't actually know. We don't have a crystal ball, but we are here to guide you through this process. So if you did like this video, you got a lot of value from it. If you could just hit the subscribe button, hit the like button, it allows us to make more content like this for you. Really appreciate you guys checking in and watching today. We'll see you soon.